Alright guys, so now it's time to take a look at our first entry model, and the first pattern we're going to take a look at is called the failure test pattern or 2B pattern. This pattern has even more names, but I first read about the pattern in this book, The Art and Science of Technical Analysis, written by Adam Grimes. I actually highly recommend that book. But before we dive into the charts here, let's just do a quick overview of the pattern. The failure test pattern is a short-term reversal pattern where the price briefly breaks either support or resistance and then quickly reverses. And one thing I really like about this pattern is that it's actually very simple. It's a simple pattern and it also has clear rules, at least for the stop loss placement. So for all trades, we want to have a stop loss and we want to have a target. And when it comes to the stop loss placement for this pattern, it's not really up to debate. There's pretty much only one place where you can set your stop loss. When it comes to the target level, we do have a few different options that will depend on your trading style, but I will show you guys some different target methods for this pattern as well. And as I said, this pattern actually have many different names and it has been around for a long time. It can be called the 2B pattern, and if I'm not wrong, this name was popularized by a trader called Victor Sperandeo. But we can actually also call this pattern a Wyckoff spring in the case when the pattern is bullish, and a Wyckoff upthrust when the pattern is bearish. So all of these different patterns, the upthrust, spring, 2B pattern, failure test pattern, they have slight variations, but to be honest, they are all pretty much the same pattern. So if you learn the general rules about this pattern, you don't really have to worry about the name. The name is not important. What is important is that we understand the actual pattern. And here, and this is very important, we can of course combine the pattern with market structure to increase the probability of success. As you guys know, no pattern will work all the time, but what we as traders can do is that we can try to increase the probability of success, and as a result, our probability of being consistently profitable. Alright guys, so now let's jump back into trading view here. I'm currently looking at Euro US dollar on the 15-minute time frame. I know a lot of you guys are often asking, what time frame am I looking at and what am I trading? But it's not really important. You can use the failure test pattern in the short-term time frame, like for example the 15 minutes, but you can also use it on larger time frames as well. But now, what about this pattern? Let's take a look at the pattern here. Well, the first thing we can notice about this chart by just briefly looking at the chart is that we are in an uptrend, right? We're printing, higher highs and higher lows. So by first glance, we can see that we are in an uptrend. So here we're looking out for bullish trades. We're looking out to trade in the same direction as the trend. But here we can also do our analysis when it comes to break of structure and change of character in order to really know that we are in an uptrend. So for example, we can see that we have a high right here, we have a low. When we break the high, remember, here we have our first, break of structure, right? Then we saw our impulsive move. We printed a new high right here. So now this right here is the high the price needs to break in order to, continue the uptrend. You can see that we had a small break right here. We pushed up and printed a new high right here. So now this right here is the level we need to break in order to continue the uptrend. We also, of course, had a low right here. Then we had a higher low. So with this green candle, you can see that we had another break of structure. After this, the price came down here and printed a low. And here is when it gets really interesting. You can see that we saw this strong impulsive move towards the upside, but then we actually saw a very strong move towards the downside. And let me actually delete all this stuff right here, because now you can see, remember that this right here is now the low the price needs to break in order to create a change of character. So let's actually draw out a level right here. And here you can see that the price quickly dipped below the level that leads to a change of character, but then quickly reversed. And here, this is actually an important concept that I haven't mentioned yet. In order to create a real change of character, what I'm looking out for here is that I need a candle close below this level. So if we get a strong candle close below this level, this is what confirms a change of character, at least in my opinion. You know, as with all technical analysis, some discretion will be involved, and some traders actually see wicks as breaks. I personally only see candle closes as breaks here, because these wicks below key levels can actually be great buying opportunities. And the trigger for this pattern is to enter here on the candle close on the candle that just quickly dipped below and then pushed above the support. But what about the stop loss level and the target level? Well, when it comes to stop losses, as I already mentioned, the stop loss for this pattern is very straightforward. We want to place the stop loss below the wick of the candle. So we want to place the stop loss below this point right here. And I also usually leave some wiggle room here. And you may wonder, why do we want to set the stop loss below this point? Well, if the price falls below this point right here, and especially if we get a candle close below this point right here, then, as you know, we have a change of character. And in this case, the trade no longer favors a move here towards the upside, and this is a clear sign that we want to exit the trade, because we only want to be in trades where the probabilities is on our side. But what about the target level right here? Well, when it comes to target levels, it's not as clear, you know, where exactly to set your target, and it can, you know, vary on a case-by-case basis. One method to place your target here is to set it just below the high of the uptrend. So right here we have the high of the uptrend. This is the high we need to break here in order to create the next break of structure and in order to maintain the uptrend. But sometimes, especially when we see such a strong reaction, you can see we have a very strong reaction, very large bearish momentum candles. In these cases, many times this point right here can actually act as resistance, and it's possible that we can see some sort of double top at this level. So locking in profits just before the high can definitely be a valid strategy. Another method you can use here to set targets is to use a fixed risk to reward ratio. So what do I mean by this? Well, a fixed risk to reward ratio, a very common one, is a 2-to-1. And this basically means that the reward you get from the trade is twice as much compared to what you lose if you lose the trade. So by using a 2-to-1 risk to reward, you don't even have to be right half of the time, because every time you win, you will win twice as much. And last but not least, a third method here is to use the measured move we talked about earlier in the course. In this case, the impulsive move was this move right here. So we can take this measurement right and measure here from the start of the next impulse move to get our target. This video was actually just a very short clip from our full market structure trading course here on the channel. To watch the full course, simply click or tap on the screen right here. I hope I will see you all over there very, very soon.